Last quarter, we told you that Manhattan was firing on all cylinders, and then the world shifted.
The second quarter of 2026 is the first quarter that we get to get a sense of what that shift meant, but it's different than most people think.
Sales fell, inventory fell faster, and median price hit an all-time record.
Welcome back, everybody, to the Real Talk NYC podcast with John and Jonathan. I am Jonathan Conlon.
And I'm John Gastaska.
My business partner of going on 20 years in just a couple of weeks.
Love it.
Oh, my God.
Love it. It's flown by.
I can't believe it.
It has flown by. It has flown by. We're doing Q2 numbers. And as a reminder, Q2 numbers are from what? Come on, folks. Wake up. Please wake up. Contract to closing 90 days. That means that the sales happened when? January to March, right?
That's
I
right.
have to teach myself because I even forget. So anyway, there's a lag in Manhattan
because
because of the
things we always
process.
have to talk about, and we have to do that. But it is always important because we report on closed sales, not contract signed. So,
Got it.
So the first thing we're going to talk about is mortgage interest rates. So we started the quarter, January and February, were right around 6%, a little under the 6% mark. Then what happened?
The war happened at the end of February, and then the basis points increased about 50 basis points. So by the end of April, 6.25%, and then by the end of the quarter, about
by the end of the second quarter,
By the end of the second quarter,
yeah. And that'll have the biggest effect on those entry-level buyers, which sounds ridiculous, but it is up to like the million mark, where there's more buyers financing. It matters more to them, obviously.
Right. So I would say that the half-point increase was one of the strongest factors that affected the quarter, particularly in the million below range for the buyers. Okay, so let's talk about closed sales. So the closed sales in the quarter were 2,849, down 6.3% year over year from 3,042 in 2025.
Yeah, and that ended the streak. We had 5 consecutive quarters of rising year-over-year sales. So that was one of the first breaks that we see in our market, and sort of which we'll talk about.
Okay, but context matters because the average 10-year second quarter numbers were about 28.17. So just because our second quarter variated between 2025 and 2026, it's still basically above the 10-year average this year.
Right.
So,
and it's not like
it's not a dire
collapse.
circumstance.
We did see an 8.1% increase in number of closed sales from Q1 to Q2, which accounts for our normal seasonality change. So what we lost was the year-over-year momentum, not the market as a whole.
Right. So the cause is more on the supply side than on the demand side. You can't buy what's not there.
Right. And that didn't happen. So we didn't have the seasonal uptick, as big of a seasonal uptick as we typically have. And we were just 4% off below what the 10-year average was.
But break it down a little further, and the new development inventory fell 62.5%, or just over 62%. That's pretty excessive, to 445 units. Resale inventory fell to a more modest 7.2% to 6,600 units.
Yeah, so you got to look, the new development's always hard to quantify because developers put on their properties not necessarily specific to the time of the year. Of course, they try to correlate those things with typical demand ebbs and flows, but they come on the market, when they're ready, they pick a time and they put it out there, but they don't wait an extended period of time to do so. So it's a little bit of an X factor there, and you have to look behind that initial the high number in order to break it down a little bit further to see is that really telling the whole story. But as you said, resales were down as well.
I find it interesting that the 3 bedrooms were down 19%. So they took the largest decrease. So the inventory decreased over 19% in the 3-bedroom category, whereas in the 1-bedroom category, down about 3%. So that would tell me, and we'll talk about it a little later as far as why that decrease in the 3% category.
Yeah, we're leading up to something.
Yep. Okay.
The next is the fun one, absorption rate. So absorption rate is months of supply versus the amount of transactions that are happening. So it came in at 7.4 months, which on its face sounds good. It's gone down from 8.2 a year ago.
But what's counterintuitive is that sales fell and the market still got tighter. So what's the
so
conclusion
because sales fell, but they didn't fall as much as inventory. The inventory coming down 15%. So that's still pushed down the absorption rate, the number of months it takes to absorb all the inventory on the market. So it still means that when you run the math, it feels like a tighter market. But whereas it doesn't necessarily mean that's exactly what happened. It's just sometimes the statistics don't tell exactly the right story.
Sure. And we look historically, and so over the 10-year average of 8.33%, 8.3 months, excuse me. So when we look at the average over the 10 years, looking at 8.3 months on average, the absorption rate, we're operating 11% faster than the 10-year norm. So
and
the markets.
We definitely saw in our business some things happening, especially in July in terms of contract signing. But again, we're talking about a 90-day delay, and it's hard to say that these jive with our business. Our business is a very small microcosm of what's going on, and we're always subject to what our clients are doing, et cetera. But statistically speaking, absorption rate, what I always like to see is that there's some consistency there. There's not a massive change or whatever. And we still, the weird market that we're in, we are still seeing sometimes bidding situations, apartments going for above ask. And that's this market trying to figure itself out, which is, I hate even to say it, but it is to clients and such. But it's still a very strange market as the world tries to figure out, or the city tries to figure out these different elements, which we'll talk about in the final takeaways.
Okay, so let's talk about negotiability and discount factor. In the present quarter, we saw negotiability at 3.3%. Okay, and then that in versus first quarter, which was 4.9%, and then versus a year ago at 5.8%. So it shows that the market was much tighter in terms of negotiability for the second quarter.
More competition, more. Now,
less
whether
property.
that means obviously inventory came down. Perhaps some of those higher price listings between where the market was going to absorb them came off the market, so you saw less negotiability there. Really, at the end of the day, when we look at the negotiability percentage, it typically bounces between a 3 and a 7%. So we always say on average around 5%. So it's not a crazy number, but as I said earlier, we had still some bidding situations, even though inventory was lower. But when the market tightens, who's left on the market are typically more realistic sellers, and those are the ones that actually get sold. So it's not necessarily surprising to me that we saw a tightening on that percentage.
So basically, sellers gave up less, and buyers had to compete more for the real estate.
Yeah, for the real estate that's left on the market.
Absolutely. A few things worth flagging. In this quarter, a record 57.9% of the deals were done above $1 million. And in that 2 to 3 million price range and 3 to 4 million price range, the numbers were up in both the categories.
Yeah, and everything below that, especially below the million, was much softer. As I mentioned earlier, the interest rates have a bigger bearing on that market. You have entry-level buyers that are watching their monthlies much closer than somebody at a much higher price point. So that definitely always affects that lower end market much more.
And in the luxury category, the median price was $6.451 million. So that was the luxury median price for the quarter, slightly down 1.1%. But the luxury listings came in at 796 listings. It was the lowest recorded number in 22 years. So that tells me a lot of people took their apartments off the market.
And last but not least, looking ahead, what did we also have in the quarter, which is we're now waiting to see how that shakes out, is the Pied-à-terre Tax.
Correct.
Now, the Pied-à-terre Tax is going to be phased in. There's 2 different phases. Townhouses are single phase based on market value. The co-ops and condos are based on the market value on the tax, the real estate tax bill. Co-ops are even more complicated. It's broken down because you get one real estate tax bill for the whole building. So that's broken down on a per share basis. We won't go beyond that, but in 2 years from now, it's going to convert to actual market value. So what the apartment would be worth on the market. So it is a complicated thing. If anybody needs help talking about it, by all means, reach out to us. We'll walk you through it and look at your specific apartment for it, because we've seen condos at north of $5 million that aren't affected. We see co-ops in the $3 to $4 million range. Your buyer that you referenced, I think in our last podcast, that it affects that in a smaller co-op on Park Avenue. So the prices there's a big range there of who's going to be affected by it. And then there's different loopholes and such or ways to get around it. If you're renting out the apartment to a primary user, then the Pied-à-terre tax is not. As long as the trigger is always, is the tenant, is the person using the apartment paying New York City New York City taxes, income taxes. So that's really the way to think about it. But whether your apartment is affected by it, if it actually falls into the category, is this nebulous thing to some degree. And there's already a lot of fights over it. There's a lot of people filing complaints and arguing that their apartment shouldn't be into it, shouldn't be affected by it, et cetera. And I don't see that slowing down. But what does that mean for our market in the short term? Now, when we have something coming through like this, whether it's a new tax or new laws that are going to be affecting the real estate market as a whole, the market needs to figure out how to absorb that. The problem with the Pied-à-terre tax, from my perspective, and then I'll let you talk, is what is it actually going to look like? Because there's already a ton of people fighting against it. Is it going to hold? Is it going to change? Inevitably, the cities, they need the money, so they're going to have to figure it out one way or the other. And unfortunately, or fortunately, whichever side of the fence you're on, the city usually gets their money. So it'll be interesting to see how it plays out. But what does that add? What does that add to our market and to buyers or sellers? Is uncertainty. There's uncertainty there. And as we always say, that's the number one thing buyers don't want to buy. And so it has affected that luxury inventory market.
Yeah, I've heard everything that you say. I definitely feel it impacting our market. I think that, putting it into play the end of May and then having it as it's going into effect, it's affecting the psychology of both seller and buyer. I've had buyers pull out of the marketplace because they do not, number one, they don't know the whole ramifications of the tax. They don't want to pay, as you were saying, a minimum of $40,000 a year as an additional tax on top of the mansion tax. And so we have this kind of question mark as far as how it's going to really impact, I would say, not only the third quarter, but the fourth quarter as well, and all of next year, until it really flushes through. I think it needs to really flush through, just like we experienced, but I think even more complicated. It's far more complicated than increasing the mansion tax. That was, boom, this is it, and it was very easy to track.
Yeah, and it's a one-time tax.
That was a one-time tax. That is
so
correct.
It's like, okay, I got to pay an extra $50,000.
Annual tax.
Yeah, which sounds like a lot of money, $50,000, but it's a one-time and then it's done. This is an ongoing situation.
And I think that it will have a far greater bearing on the marketplace.
Yeah.
And I, for one, am not a fan of it.
Well, listen, if I were to pull out my crystal ball, there's one thing that I would say for sure is that we're going to see a real freezing up of that market, that luxury market, that probably north of $3-4 million.
We already are.
We are already seeing it, but I'm saying in terms of the numbers, which are the closed sales, that will absolutely become evident next quarter. Again, if I had a crystal ball, and I wouldn't I would not be surprised if
So
we see some significant
The last
drops.
takeaway is more shall be revealed, and so people will have to tune into next month.
We
Next
gotta watch
quarter.
it.
That's right, next quarter. So listen, great to see you as always.
Likewise.
And thank you all for tuning in. It's wonderful to be with you today. And so most importantly, be healthy, safe, and
Remain in gratitude.
we'll see you next time.
See you next time.